Good morning and welcome to today's webcast, Utilizing New State Tax Cap Workarounds, Key Considerations. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters from Moss Adams. Mark Hawkins, Director, Lawrence Kahn, Senior Manager, Chris Parker, Senior Manager, and Jennifer Young, Director. And with that, I will turn it over to Chris to get us started.
Thanks, Emily, and thanks everybody for joining us today to talk about the pass-through entity election and what that tax credit means for people looking at the opportunity. In today's presentation, we're going to start with a little bit of background on the federal SALT limitation, the relief opportunity that has been presented by the IRS and now the states are starting to adopt, a little bit on the variety of programs among states with a focus on some specific state programs that are in effect today or coming into effect very soon, and then we'll close out with a quick recap and hopefully have some time for questions and answers in those last few minutes of today's presentation. If you do have questions, please feel free to push them into the chat and we will take a look at them and try and get to them before the presentation closes. So, Emily, we're going to move into a polling question and get a little sense of who our audience is today. I'll hand it back to you.
All right, our first polling question. Have you or your clients heard about the elective pass-through entity tax program? And your options are A, yes, B, no, or C, what are you talking about? And I'll give everyone a few moments to respond here. Just a reminder, to be able to participate in our polls today, click the button next to the answer you choose and hit Submit.
And while people are answering the question, we have a last-minute addition to the presentation team today. We're fortunate to be joined by Bob Reynolds, who is a state and local tax partner in our California group. So Bob is here with us today as well. And Emily, what are we seeing on the poll results?
All right, I'm going to go ahead and advance to the results here. And here we are.
Good deal. All right, and I think we have one more question, right?
Yep, and we'll move right into our second polling question. Are you or your clients considering a large transaction? And your options are A, yes, we close next week. B, in 2022. C, now that you mention it, let's talk. Or D, not yet. So we'll give everyone another moment to respond for our second poll.
And this polling question was generated because we do have a lot of clients that are considering transactions right now, and the impacts of the elective workarounds are top of mind for the state tax implications, where somebody has a multi-million-dollar transaction, they're getting ready to sell their legacy business or a line of their business, and thinking about the tax ramifications at both the federal and state levels, particularly with some of the uncertainty at the federal level that we're seeing. People want to lock in that tax cost now and then thinking about how to mitigate it. So Emily, what are we seeing on the poll results?
All right, and here are the results.
Okay, interesting mix. 10% close next week. All right, well, very good luck to you. I know how stressful that is. 2022 is almost 20%. Great timing to be thinking about your transaction now. The 7% now you mentioned it, let's talk. Okay, we're here for you. And the not yet at 64% is very good. It means you've got lots of time to think about what you want to do and build out a thoughtful plan as you take the reins on looking ahead. All right, so let's move into a little bit of background on the federal SALT limitation. This was added as part of the 2017 Tax Cuts and Jobs Act. It became a $10,000 problem for states that have high income tax rates or sales tax rates or significant property taxes, or all three. And this basically put into place a $10,000 cap on your federal return that would limit the amount of deduction you got for state taxes paid. There was a recognition at the time that this was put into place that businesses would not be subject to this $10,000 annual limit, which is the genesis of the credit that we're going to be talking about today. There is a significant tax burden on individuals that reside in states that have these significant tax rates, be they income tax, sales tax, or property tax, or all three. So states have been continually asking, what can we do to provide some relief to our residents? And the IRS, in Notice 2020-75, which was issued last November, signals a willingness to allow payments made at the business entity level to provide a credit to individuals, and that credit is where the relief opportunity comes. So what does this mean? And there's some specifics in here about this being a specified income tax payment paid at the partnership or S corporation level on behalf of the individual. We have a lot of slides. We're going to go through the ones that stand out in terms of significance. So just at a high level, the graphic here shows you have this entity that is paying the state tax, and then the individual is receiving the tax credit. So that's what's happening at the state level. And as we'll get into later, each state has their own little nuance to how this actually functions, what's allowed, what's not allowed, which entities are allowed to participate and which entities are not allowed to participate. But the bigger question then is, okay, so how does this translate into federal relief? And that is, you have the recognized entity, because they are not subject to the $10,000 limitation. They get to deduct the tax paid at the state level on their federal income tax return. So you're actually seeing that reduction happen in your federal tax return reporting. That's why it needs to be a recognized entity, because if there's nothing reflected on a federal return, then there's no federal benefit. That reduces the flow-through or pass-through income to the individual or trust. So prior to the issuance of the revenue ruling from last November, 7 states had enacted this elective pass-through entity tax structure. Since 2020-75 was issued, we've seen an additional 13 states, including some of the states we'll talk about today, like California. Unfortunately, though, the IRS has not provided a lot of additional guidance. They've given us this revenue ruling that lays out some broad parameters, and then what we see is the states taking it from there and creating solutions, in their mind, that are effective for their residents. And so what you see here is kind of a graphic of the variety of different programs that are in place across the states You'll see that some states have programs that are effective in 2021, other states have programs that are effective in 2022, and still more states have programs that are yet to be effective or yet to be created. One of the challenges is that these programs are literally being added as a layer onto the existing state income tax regime. So with California, for example, AB 150 was recently passed earlier this year. It is a whole new set of rules and program structure that sits on top of the existing California Revenue and Taxation Code. And what we see in other states like Oregon and New York is the same. They've created an entirely new regime and structure that is now essentially glued on to their existing code with the idea of trying to create this relief opportunity for what looks like, at the moment, a very limited window of 2021 to 2025, with the idea that the Tax Cuts and Jobs Act expires on 12/31/2025. That means that the states that are trying to produce this are also thinking about this very limited window. Now, the caveat to that is we now see some federal proposed legislation that may upend that window. Until we have more clarity on that, though, right now, everybody is focused on 12/31/2025 as seeing when this program likely ends. So at a high level, the things you want to start to think about as you're looking at the analysis of a pass-through entity taxation by state. When is the deadline for making the election for each state? And this is one of the nuances by state program that becomes very challenging, is that states have implemented a variety of different deadlines for making the election. A number of states require the election to be made on an original return, so no extended due dates, let's think about this, you actually have to get something early. Some states are putting that original return filing date on the business entity's original return, so you're looking at a March 15th, 2022 date for filing those elections. So this deadline issue is becoming really important. Then we move into whether the entity is eligible, and that was what we were mentioning before, and we'll get into specifics here in a couple minutes. Different states have different rules about which entities are allowed to participate as qualified entities for purposes of electing into the pass-through entity regime. And then we move into the question of what income is subject to that election. So in California, it's the entire distributive share that is pushed out to the member. In other states, it is a portion of the source income, or it is a post-apportioned income. So this income analysis becomes important. And then which owners of the entity are eligible to participate. So for example, maybe you have an entity that has a partnership as an owner, an LLC as an owner, and an individual as an owner. Not all three of those entities may be eligible to participate in, or excuse me, not all three of those members may be eligible to participate in the entity's relief program because of their own structure. So you actually do have to think about how the pass-through entity's members are structured as well as the entity itself. And then fundamentally, the question is, does this all make sense? It's a tremendous amount of work, particularly if you have a business in one state and members across multiple states, to model out how these tax benefits are going to be available, what they're going to mean, what that flow-through opportunity is going to be worth. And so there's a fundamental question of, does this make sense to do, or is it just a heck of a lot of work for not much reward? Just some other quick issues to think about. Is it only on source income? Are residents and non-residents treated the same? This is something that we're seeing with certain states where non-residents and residents are not treated the same. So if you have members of an entity that are different, some being residents, some being non-residents, you may see a different application of some of these rules. Does making the election for non-resident owners make it ineligible for them to claim tax relief in their state because of some other difficulties that we'll talk about with regards to integrating an other state tax credit and the pass-through entity elective tax credit? And then there may be additional issues that you need to consider with particular income and entity types. And Emily, that moves us into another polling question.
All right, our third polling question. Are you ready to take advantage of this opportunity? And your options are A, yes, I'm calling my tax professional now. B, no, I need more information first. C, this seems more complicated than I thought. Or D, how much will I really save though? So we'll give everyone a few moments to respond here. And for those of you that would like a copy of today's slide deck, you can download them from the folder that says slide deck and handouts to the right of the slide view. We'll also be sending the slides via email after the webcast. A couple more seconds here.
Great, thanks, Emily. And these are the questions that a lot of our clients are asking us right now. When we have this initial conversation about the application of these rules, particularly across multiple states, then what does that mean, and how do I model that out, and what are the actual savings? Is it going to be worthwhile to go through this exercise, or am I just going to generate a lot of paper and really not save very much in tax? So, Emily, what are we seeing in terms of the results?
All right, let's take a look. Here are the results.
Great. Yeah, and I think that's pretty much consistent with what we're hearing with clients that we serve currently. Is there's a lot more who want more information. It is much more complicated. The how much will I really save being a strong third place makes a lot of sense. So let's get into some specific programs and think about what that looks like. But before we start that, I just want to bring to your attention, and actually I'll turn this over to Mark. The Maine Board of Tax Appeals was looking at this issue, and Mark, what did they see?
Yeah, so thanks, Chris. What this Maine case does is illustrate the problems that individuals that are residents of a state that offers very restrictive rules on the application of credits for taxes paid to other states when those income taxes are paid by the pass-through entity. In this case, you had an individual that was a Maine resident that was a partner in a partnership that was subject to Connecticut's mandatory pass-through entity tax. And this individual claimed a credit on their Connecticut non-resident return for their proportionate share of credit of tax that was paid by the pass-through entity to Connecticut, and Maine disallowed the credit. Maine's rule was that no credit is allowed unless paid by the individual, and Maine held that the individual did not pay any tax to Connecticut. And so this Maine case illustrates the problems and challenges that we will see when dealing with pass-through entities that have owners that are residents of multiple states.
Great, thanks, Mark. So let's get into some specific state programs. We'll get started with California. Lawrence?
Yes, thank you, Chris. So given the IRS has provided a pathway through this Notice 2020-75, in July of this year, California enacted AB 150, and this allows partnerships and S-corps to elect to pay this income tax at the entity level at 9.3%. And thereafter, the partnerships and S-corps are able to reduce their federal taxable income. Afterwards, the owners receive a credit for the taxes paid by that partnership and S-corp. So as a result, the owners are able to bypass that federal $10,000 cap limitation on income from the partnerships and from the S-corporations. So AB 150 is part of a new California code that allows for this election, but it's an election and it's not mandatory. So there are two important terms in AB 150 that provide restrictions on the types of entities that in an org structure that can take advantage of AB 150. And the first important term is qualified entity. And in a qualified entity is what we would expect. That is a partnership or an S-corp. And this also includes LLCs, tax-less partnerships. However, there is a limitation. The owners of this qualified entity cannot be another partnership or an LLC tax-less partnership, meaning a partnership that has another partnership as a partner or member cannot elect AB 150 on behalf of that partnership. So the alternative here is determine whether further up in the org structure may that owner elect AB 150 because it's also a partnership. And then with respect to qualified net income, once an election for AB 150 is made, that 9.3% tax is on the qualified net income of each qualified taxpayer. So that is a taxpayer who consents to this election. So next, let's look at the second important term here, and that's qualified taxpayer on the next slide. So a qualified taxpayer, first, it could either be individuals, a fiduciary, a state, a trust, that's subject to California personal income tax, and it's an owner in the qualified entity. As to the limitation, a qualified taxpayer cannot be a disregarded business entity. That means single-member LLCs do not qualify, and they cannot look, and you cannot look through that single-member LLC to have the marked partner or member of that single-member LLC to be a qualified taxpayer. As a result, we'll need to consider either dissolving that single-member LLC or creating a partnership out of that single-member LLC to take advantage of AB 150. The other entities that cannot qualify are corporations and partnerships. So once we have a qualified taxpayer that consents to that AB 150 election, that 9.3% tax is calculated on the income from the partnership based upon residency. So if the qualified taxpayer is a California resident, that 9.3% tax is applied before allocation and apportionment. Conversely, if for qualified taxpayers that are California non-residents, that 9.3% tax is applied after apportionment, meaning only on the non-resident's income that is sourced to California. A couple other terms from an administration perspective it's the partnership, the LLC, the S corp that makes the election. All right. So after that election is made, the owners of that partnership, the LLC, the S corp making that election, can choose to consent to have their share of that pass-through income included in the 9.3% tax to allow for the credit to flow through to them. And the last point here is if we have a qualified taxpayer of a qualified entity, AB 150 allows for the owner to consent or not consent. And so this allows for some freedom to be part of the election and without impacting the other owners. Once this election is made, okay.
Lawrence, on the credits that we're looking at now, I think this is where one of the questions that's already starting to crop up with clients and that we're seeing show up in some of the chat is, what is this qualified income that's now subject to the credit, and what's the qualified amount? And part of what's happening is the 9.3% tax at the S corp level is in addition to the 1.5% tax. So you essentially are paying 10.8% tax for a California S corp, because California is unique in having an S corp level tax where other states do not. So you're paying this 10.8% tax at the S corp level, and then that 9.3% of that is generating a credit for the individual shareholders on the distributive share that comes out on the K1. So that K1 is really where the action is happening, and what we're waiting for is the California Franchise Tax Board to provide a little more clarity on what they're going to make some new forms, and we have not seen exactly what these new forms are going to look like in terms of tracking the qualified amount of income at the entity level and how that translates into income tax credit that you can take at the individual level. And then with California, the other interesting issue that we're waiting for some clarity on is California has said so far that the PTE credit does not reduce tax below the tentative minimum tax, which means there is exposure to the California AMT, Alternative Minimum Tax, for 2021. We are in a working group that is trying to make have a conversation with the legislature about changing that TMT issue, but just be aware, this is one of those things that I mentioned earlier with regards to nuances in particular states. Right now, we have a California AMT issue that we were not expecting when this legislation was passed, but that is the way the Franchise Tax Board has been implementing this proposed program at the moment. And with that, I'm going to move on to Jennifer and talk a little bit about Oregon.
Thank you, Chris. As we mentioned, the opening diagram is really useful for seeing big picture how these mechanisms work, big picture. But just like when you fly over the United States at 30,000 feet, you lose a lot of granular detail. State tax is kind of the same way. You really do need to dive down and look at each state where you might be impacted to see what the net result is going to be for yourself or for your clients. So we'll see some of those differences going through Oregon, between California and Oregon, kind of an object lesson in just how two different states can be so different from each other. The Oregon election is made Senate Bill 727, SB 727. It's effective in 2022, so it's not available yet for 2021, and right now it's 2022 and 2023 tax years only. In Oregon, entities that can make the election are entities that have all individual members or an entity member that's a pass-through owned entirely by individuals subject to personal income tax. So examples of entities that can make this election are an LLC owned 100% by individuals, an S corporation owned 100% by individuals, or an LLC owned by individuals and S corporations. The entity that the mechanics for making the election are either each member of the electing entity that is a member at the time the election is filed needs to assent to the election, or any officer, manager, or member of the electing entity who's authorized to make the election can make it. The election is made each year and cannot be revoked, so it's final for that year. Unlike some other states, the election is made on the return as timely filed, including extensions. So the election can be made on a properly filed extended return. The one way to revoke an election would be if the original election is made on a return that's filed before the due date, and then another return is filed on or before the due date. So that would count as almost a superseding original return and not an amended return. The tax is calculated on the sum of each member's share of distributive proceeds apportioned to Oregon. So here's another huge difference between California and Oregon. So whether you're an Oregon resident or not, the tax is calculated on apportioned Oregon income. And it's 9% on the first $250,000, 9.9% after that. The SB 727 has directed the Department of Revenue to promulgate some rules. Right now, we do not have any rules, forms, or vouchers for this tax yet. Once the election is made, then the entity is to report to each member its share of distributive proceeds and its share of the tax paid. Then each member computes Oregon tax on Oregon income and takes a credit for the tax paid by the entity. Unlike some other states, a non-resident, even one whose only Oregon activity is a member of an entity that makes this election, the non-resident still needs to file an Oregon non-resident return, calculate Oregon tax, and then take the credit. And here is another major difference between California and Oregon. In Oregon, the credit for the individual share of the tax paid is refundable. So if the entity paid tax on behalf of a member of $100,000, but the member, for whatever reason, has Oregon tax of $90,000, then that $10,000 is refundable. That's another big difference between Oregon and California. There are several, as for most other states that have layered in this law, there are several open items right now. The Department of Revenue is to issue rules for implementing, but we don't have any proposed or draft rules at this date. We don't have any form that says how the election will be made. We don't know if this will be a checkbox or an additional schedule on the pass-through entity return. Moss Adams, we've asked the department to advise on the interplay of this election with the credit for taxes paid to other states, since California and Oregon and some other states employ a reverse credit mechanism where an Oregon resident that is a California non-resident, if that entity makes the election, we don't know right now if the Oregon resident will be able to take a credit for the California tax paid by the entity. That's an open issue. And the department has said they'll get back to us. I think we sent that question in before October 15th. So that is a big open item. Another open item here is the SB 727. When it talks about qualifying entities, it refers to individual members. And SB 727 does not define what an individual is. Other sections of Oregon Code define an individual as a natural person. And so a plain reading of this would indicate that a trust member of a pass-through entity would invalidate or would make that entity ineligible to make the election. That's a big open item we have here. So an S Corp, for instance, that has a grantor trust as a member, there's a potential that that S Corp could not make the election. And that would mean that all of the members would be precluded from the availability of this benefit. That's a big open area that we are communicating with the Department of Revenue on to see how they interpret it. Oregon's definition of a pass-through entity is tied into federal right now, and it's not modified for whether an entity has elected to be taxed as a C corporation or not. For instance, states that require that have a requirement for a specific S Corp election, like New York, for instance, if an S Corp does not file a New York S election and so is taxed as a C Corp for New York purposes, it's still a pass-through entity under current code for Oregon purposes. Idaho has also layered in this law. It's House Bill 317 that's effective for 2021 and future years. I don't see a time limit on Idaho's yet. All pass-through entities are eligible to make the election for Idaho. The election mechanics are somewhat similar to Oregon's at this point. Either every member of the electing entity that's a member at the time the election is filed, or a member who's authorized to make the election can make it. It's not revocable for the year that it's made, although it is not binding on future years. It's made every year. It's calculated on the sum of all separately and non-separately stated items at the corporate rate. The tax is due April 15th of the next subsequent year. And again, we don't really have rules, forms, or vouchers for this tax yet. So there are detailed instructions that are going to be forthcoming. And here is a difference between, although the mechanics between Idaho and Oregon are somewhat similar, One difference is that a non-resident that doesn't have Idaho source income from other than from entities that have made this election don't have to file an Idaho return. So the responsibility to file an Idaho return is extinguished, and that's a big difference between Oregon and Idaho, goes into the administrative burden here.
Great,
so
thanks, Jennifer. Really appreciate. Yeah, really appreciate your walking us through on Idaho and Oregon. And Mark, we'll turn it over to you and take a look at Illinois.
Yeah, thanks, Chris. Move across the country and cover some other significant states and other regions. I think this is just going to be a very high-level thumbnail sketch of these states. When evaluating this, like Chris said, it's very important to do the modeling, to understand your facts, look at the structure, understand the residency of the pass-through entity owners, and run the calculations. So beginning with Illinois, Illinois this year enacted legislation that a pass-through entity can make an entity-level tax in Illinois. The tax is effective for tax years ending on or after 12/31/2021, but it sunsets at the same time the TCJA SALT limitation goes away under current law. It's important to note that the effective date is tax years ending on or after 12/31/2021. So if you have a fiscal year ending in 2021 that's not 12/31, then you're ineligible for the election for 2021. The legislation was fairly high level, with the legislature instructing the Department of Revenue to issue regulations to fill in a lot of the gaps and add clarity. The tax base is similar to that of Oregon, where it's only computed on the Illinois source income of the pass-through entity after allocation and apportionment. So it's different than California with respect to residents, where residents are taxed on 100% of the income irrespective of sourcing. Sorry about that. So one nuance with Illinois is that Illinois has this parallel income tax structure called the personal property replacement tax. That is a 1.5% entity-level income tax on partnerships as corporations, and also C corporations. The Illinois pass-through entity tax calculation for electing pass-through entities will use a different tax calculation than the PPRT. So it'll be instructive as to how Illinois creates these forms, because there will be different sets of modifications necessary to compute the tax base for these taxes. Illinois will require estimated payments if the pass-through entity is expected to owe more than $500 annually. So Illinois flows through the benefit in the form of a credit structure for individuals and C corporation owners. So the individual and the C corp owner will take a credit equal to 4.95% of the owner's distributed share of income flowing up from the electing pass-through entity. In a tiered pass-through entity structure, it's a little bit different. If the upper tier owner is an electing pass-through entity paying this entity level tax, the electing pass-through entity will actually have a subtraction modification equal to the amount of flow-through income from the lower tier entity that already elected. So this is the way that Illinois avoids doubling up on the tax base when you've got a tiered flow-through entity structure. With respect to non-resident owners that of a pass-through entity that elects into this regime and have all their Illinois Illinois income tax is assessed against 100% of their Illinois source income, they don't have to file. They are relieved from having any individual filing responsibility. Moreover, any pass-through entity that opts into this regime is no longer required to withhold Illinois income tax on its owners, or I'm sorry, on its non-resident owners. For residents, Illinois permits residents to credit on their share of pass-through entity tax paid to other states by the flow-through entity in those regimes that are substantially similar to that of Illinois. So Illinois should not have the same sort of problems that we saw with that Maine example, as long as the other state has a substantially similar tax regime to that of Illinois, which will probably substantially similar is not defined. It will be up to the Department of Revenue to add clarity on that through the regulatory process. So moving on to New Jersey. New Jersey has had what's called the Business Alternative Income Tax since January 2020. I saw a question on this earlier. Business alternative income tax is just the name of the tax. It's just the New Jersey's unique name that they've ascribed to this regime. The election for the pass-through entity tax has to be done by the original due date of the return for the tax year to which it will apply. So for the 2021 tax year, the BATE election must be made by March 15th of 2022. The election is either made by through consent of 100% of the owners or through an officer or a member of the entity that is empowered to make that election under state law. With respect to New Jersey, it's important to keep in mind that there are two separate mechanisms or two separate ways to compute income tax in New Jersey. Individuals, trusts, estates, partnerships compute their income under what's called the gross income tax chapter of in New Jersey. C corporations, S corporations compute it under the corporation business tax. These two regimes are completely separate from one another. It's really important to note that with respect to this New Jersey BATE tax, you have a partnership or including an S, or you have a pass-through entity, which includes an S corporation that's going to compute their income based on the gross income tax rules. Again, like Illinois, like Oregon, the tax base is based on the New Jersey source income of the entity after allocation and apportionment. When apportioning income, the pass-through entity is going to use the gross income tax rules, i.e. the personal income tax rules, to source the income. Under New Jersey's personal income tax, pass-through entities use an equally weighted three-factor formula based on property, payroll, and sales, with sales and services being sourced to the location where the service is performed. Corporations are still going to have to file returns and still going to issue K-1s in the case of S-corps. They're going to determine their New Jersey source income under corporation tax rules, which means single sales factor and market-based sourcing. So we can easily see where there's going to be a mismatch between the tax calculations when the credit eventually flows up to the C corporation owner or the individual owner. For S corporations, so as Chris mentioned earlier, these taxes are in addition to and not in lieu of existing taxes. So any partnership S corporation that makes the BATE election is still required to file a New Jersey 1065 in the case of partnerships, or 100S in the case of S corporations. They are still required to do a flow-through entity or pass-through entity withholding or withhold tax on non-consenting shareholders in the case of S corporations. They can also participate in composite returns, and I'll show you later on how the composite return allowance can still be helpful to owners. So with respect to credits, an owner that the benefit flows up in the form of a credit. So the owner will claim on their New Jersey return their share of proportionate New Jersey BATE tax paid by the underlying pass-through entity. The credit is refundable for individual owners. For corporate owners, it's also refundable, but it can only be applied. It can't be refundable because it's applied down to the amount of the minimum tax, and any unused credit is then carried over for the next 20 years. Like these other taxes, there's an estimated payment requirement. So, with respect to credits, New Jersey residents can claim a credit for taxes paid by the pass-through entity on that BATE income paid to other states. So, again, New Jersey's regime is going to be more similar to that of Illinois rather than Maine, where it's fairly generous on the application of credits to its residents. With respect to non-residents, this is where it actually provides an ease of use, because non-residents can still do a composite return and they can apply the BATE credit on the composite return. So this is a way to avoid the potential doubling up of the tax temporarily, where a pass-through entity is paying BATE tax as well as doing withholding. In this case, the credit would be the BATE electing pass-through entity will have their owners into a composite return, and then the composite tax will be satisfied through the application of the BATE credit. So something really important to keep in mind there. And then finally with New York. New York's 2021 budget bill enacted this pass-through entity tax regime. It applies to partnerships, LLCs, and the S corporations as long as the S corporation has made a New York-specific S election. New York and New Jersey are the two states in the country that if you have a federal S corporation, that S corporation must make a state-specific election to New York or to New Jersey in order to be treated as an S corporation for state purposes. Again, for S corporations, it must be made by an officer that's authorized to make the election. Similar rules apply for partnerships and LLCs. For 2022 and beyond, the election to opt into the New York pass-through entity tax regime has to be made by March 15th of the year to which it's going to apply. So for 2022, the election must be made by March 15th of 2022. So it's going to come right up very soon. As with these other taxes, the New York pass-through entity taxes in addition to and not in lieu of other New York taxes. For partnerships, the tax base, it is a hybrid approach. For resident owners, the tax is computed on 100% of the income flowing up from the pass-through entity after New York modifications before allocation and apportionment. So it's on 100% of the federal income after New York modifications if we're dealing with a partnership. For S corporations, backing up for partnerships, that's for residents. For non-residents, again, it's only on that portion of New York modified income that is sourced to New York. So it's a hybrid approach where residents are taxed on 100% of their income, non-residents are only taxed on the portion of income sourced to New York. For S corporations, it doesn't matter if you're a resident or a non-resident. The S corporation's electing pass-through entity tax base is only going to be on the post-apportioned income of the pass-through entity. New York is similar to New Jersey in that the personal income tax exists under an entirely separate article, Article 22, as opposed to the corporation tax, which is Article 9A. Under the New York electing pass-through entity tax, all pass-through entities, including S corporations, are going to compute their income and apportionment under Article 22 rules, which means under Article 22, it's three-factor apportionment, sourcing services based on the location where the service is performed. C corporations and S corporations are still going to file their returns and compute New York source income using single sales factor and market-based sourcing. So as with New Jersey, there is the high potential for mismatch between New York source income determined by the electing pass-through entity and then what eventually appears on the K-1 in the hands of a C corporation or an S corporation shareholder. So this is why it's really important to do the modeling before making the decision to dive in and make the election. One thing to point out here. So when making this election, look to your organization structure. If there is a partnership or a C corporation in the structure, the partnership can still make the election. It's just not going to include in its tax base any income that flows up to an upper tier partnership owner or to a C corporation owner. Sorry, I think we got a duplicate slide there. As with New Jersey, as with Illinois, New York will afford its residents a credit for taxes paid by the pass-through entity to other states, so long as those other states have substantially similar regimes. For non-residents, they will get a credit for their share of New York tax paid by the pass-through entity, but they can't claim the credit on a composite return. So it's really important to make individual shareholders aware that if they've historically been filing composite, the electing pass-through entity that makes this election, they're no longer going to be able to file composite anymore. They will all have to file individual returns, which may create an administrative cost for these individuals. Also, finally, any New York pass-through entity owner is still going to be required to make estimated payments to New York, even though the pass-through entity has made this election and is also making estimated payments. Just something to keep in mind when weighing the temporary expense associated with making this election.
Thanks, Mark. And Emily, that moves us to our last polling question for today.
All right, our final question. How many states did we discuss that apply to you or your clients? And your options are A, none, B, at least one, C, 2 or 3, D, how many more can we talk about? Or C, get me out of here. So we'll give everyone a couple moments to respond to our final polling question.
And Mark, you raise a good point. What we're seeing with a number of clients that currently file composite returns is that now they have to file an actual non-resident return in any of these states where they're trying to get this pass-through entity tax credit. And that's really going to put a burden on a lot of folks because they've been used to the composite regime and now all of a sudden not so more. Is that what you're seeing?
Yeah, Chris, good point. As a general rule, approximately 30 states offer composite returns, and it's a rare instance where a composite filer is allowed to take a credit on the composite return. And some states will address this, like New Jersey has, where they're specifically allowing the credit for electing pass-through entity tax paid. But in cases where it's silent or the state will specifically say you can't do this, then it's going to be important to communicate to the shareholders, to the owners, that in order to take advantage of this benefit, their administrative costs could very well increase substantially.
Great. Emily, what are our results for our poll?
All right, let's see what everyone had to say.
All right, well, 5% of you are already done, but that one we completely understand. 10% of you want to talk about even more states. I'm really glad that at least about 38% plus the 36%, we've at least covered a couple states that you're probably interested in. So just a quick recap on some of the things that we've talked about today in just terms of what you want to start thinking about as you're examining, exploring the pass-through entity tax. You want to review the states in which you are considering trying to take advantage of the pass-through entity workaround opportunity with a focus on the apportionment at the entity level and the taxable income states. Identify any limitations in the ability to make the election across the states where you may be trying to take advantage. So that limitation may be on the entity, it may be on the shareholders, or maybe on both, depending on which states are in the filing environment that you're exploring. Identify the election and payment dates for each state. Think about the benefit and election of the across the states where you may be filing, and then communicate to owners and members of the various pass-through entities that are involved so that they are aware of what that means for them. And just high-level federal tax considerations. S corporations have a pro rata allocation of deduction issue, and that means that because you may have members of the S corporation that are electing and members that are not electing, the members that are electing are now theoretically getting a different distribution than the members that are not electing. That could potentially create a federal S corp election problem. So if you have the IRS suddenly turn and say, we really don't like this after thinking about it a little bit more, you now may have exposure to the qualification of your S corp. Partnership, you may need to look at the partnership agreement provisions that allow the allocation of a tax deduction. And then if partner or shareholder makes the election in his or her residence state, is it based on their entire distributive share or only a portion of their distributive share? And with that, we'll move into some questions. We want to put up here the email contact information for all of your presenters today. But since we did get the privilege of having Bob join us, do you want to talk a little bit about some of the California questions that we've seen coming through in terms of making the election this year and payments this year, and this TMT issue has generated a few questions as well?
Sure, Chris, thanks. I know we have lots too. And Moss Adams was at the table working with the legislature through this. We focused on getting the federal benefit, not having different types of entities mess it up, for lack of a better term. A good example is a partnership. It has S corps, it has trusts, it has the individual unincorporated partners, and so the concern was if one elects, a lot of states just said you all have to be the same type. You cannot mix and match. In California, we were successful in doing that and saying, with the exception of a disregarded LLC, that's out, and also combined reporting. An example of this, Chris, basically is probably the best way. A lot of questions here is, let's just say, let's use round numbers. You have you're an individual partner. You have a and let's just say, for lack of a better term, you're in California, and for that reason, you have a distributed share of $1 million for the year for 2021. You elect 9.3% of that amount is withheld on your behalf, and that tax is paid on your behalf by the entity to the state of California. And that amount at 9.3 is $93,000. When you receive your K-1 for federal, it'll be the $1 million minus the $93,000. So your K-1 will show $907,000 as subject to tax by the feds. Now, you can see the ROI. There's a 37% rate. At the federal level, you save money. What happens on the state side? The state side, that $93,000 is remitted to the FTB. That the FTB is putting out some Q&As right now. They're, being the cash taxpayer, you want to get that typically in by 12/31. The FTB is, correct me if I'm wrong, I think they might be giving a little bit of grace there, but you'll have to let me know. And then the money goes to the FTB on your behalf, that $93,000. Now, you get a credit. You can use it on your individual tax return. Chris, you're right. The composite return is a group return. It's not a true, real return for this purpose. Mark said it. You can't really claim a credit on a composite. So you have to file a tax return if you're a non-resident. We're sticking with the California resident for now. So now you want to be able to use that entire credit. One thing that was missed was the ordering of credits. So in that regard, just quickly, California has an AMT provision with a 10 minimum tax similar to federal. And Mark Hawkins told me there's only like 2 states in the entire U.S. that have them, and congrats, California is one of them. So California just says, even though you're not subject to AMT, you are subject to a limitation on your credits where you can only use it to reduce your tax down to 7% of the remainder of the tax. So guess what? You put in 9.3. Mind you, on $1 million, you're going to be paying 12.3%. So you're going to get a benefit of driving 12.3% down to 7%. But that credit cannot go currently down below 7%. And Chris, that's what you're talking, we're working with the legislature right now. And so the election, the payments are basically cash-based, 12/31. The election, they just say has to be on a duly filed return for the entity level. Right now, I think there's a question about whether there's extension or not. I haven't looked at provision. The FTB is coming out with more Q&A, and there's a reg project coming. I would be more conservative and just going by the 3/15 date that you're going by, just to make sure. But the biggest item is you're going to get your credit, excuse me, over 5 years if there's this TMT problem is not lifted. And so that's where the benefit is. That's how the credit works. Essentially, it's more complicated for non-residents. Jennifer is mentioning that. You're all mentioning that. So the entity level is important. Last and not least, the S-Corp. If you have an S-Corp who's also a partner, the S-Corp is not eligible at that level. But guess what? Because that S-Corp is a partner in the partnership, it can elect on its own and have that shareholder of that S-Corp elect if they're an individual. Back to you.
Thanks, Bob. Yeah, a number of the questions that have been coming through are looking at the interface of the PTE credit and other state tax credit, and then how this factors in with the distributive share analysis for partners or members that are receiving this. And Mark, do you want to touch on that high level? And I mean, we've got a couple minutes left here.
Yeah, thanks, Chris. This is why modeling is so important, because it's identifying what the pass-through entity tax effect is going, electing pass-through entity tax effect is going to be in the state where you're making an election, and looking at what the knock-on effect is in those states where the pass-through entity has owners. It may be a simple analysis. If the pass-through entity only does business in one state and only has owners that are resident of that state, that's a pretty easy analysis. If you have a pass-through entity that does business in 30 states and has 100 different owners, and those owners are residents of 20 different states, then you have a much more complicated analysis to go through. It is really important to weigh the economics as well as to communicate whether, in some instances, while the election is beneficial for the vast majority of owners, there could be some owners where it's actually detrimental because the loss of the credit for taxes paid to another state is greater than the federal benefit by having the tax be deductible. And just, again, I can't emphasize this enough. It's really important to do the modeling, to look at the state law of the credits in these states where you have resident owners.
Thanks, Mark. I appreciate that. And there are a number of other questions that have come through. One just highlight question that several people have asked in terms of eligible entities and eligible members. So at least for California, a single member LLC is not an eligible entity, and it is not allowed to take the credit, so it's not an eligible member either. However, the Franchise Tax Board, in their frequently asked questions, has said that just having an ineligible member as part of an otherwise qualified entity will not disqualify the entity. So what you're going to be looking at as you're evaluating this is there a federal return for this entity? So that's one of the reasons an SMLLC doesn't qualify. And then what does that federal return, how is that going to get passed out to the individual members? Again, California also says that if you have a tiered partnership, a lower tiered partnership cannot push credit up to an upper tier partnership. So you have to get to the higher tier partnership that has the individuals or trust, and trust can be an eligible member in certain circumstances as the qualifying entity. And with that, thank you everybody for your time this morning. I know the hour always goes by fast. Please don't hesitate to reach out with emails or reach out to the program team as well. More than happy to take more questions on this. And as we get more information, we'll very likely need to do another one of these sessions early in 2022 because the states are continuing to review and evolve, and more states are thinking about adding these programs. And with that, thanks everybody, and good luck.
Thank you, Chris.
Emily?
All right. Thank you, Mark, Lawrence, Chris, Jennifer, and our special guest, Bob, for a great presentation today. We did have a lot of questions coming in, and we'll be doing our best to follow up with you after the webcast. Or as Chris mentioned, you can reach out directly to any of our presenters. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 3 weeks should you have any difficulty downloading it now. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.